So the Fed met on what day? Tuesday? Or was that Monday?
Tuesday and Wednesday. So it's a 2-day Fed fiasco.
Okay, so let's go through everything. Let's go through the highlights of the meeting, and then we'll talk about how that affects mortgage rates, what's going on with the unemployment, and we'll get into all that. So tell us about the Fed meeting.
Yeah, so they did exactly what they said they were going to do, right? So they're still battling inflation, so they raised interest rates 25 basis points, which was like perfectly on schedule with what they had planned on doing, what Wall Street planned on them doing, and all that good stuff. And so we know that, right? So that doesn't do, when they came out of that meeting and like the Fed raised rates 25 basis points, the markets didn't do anything. They're like, oh, okay.
Well, we knew that. We knew
like, wake us up for breakfast.
Yeah, exactly.
So that was on par. So they've gone from basically 0 to 4.75% in a year,
right?
Which is just substantial. Like that's the fastest they've ever raised rates. And it's because the Fed, they really got caught. Like they got caught naked, right? Like they're seeing out, like we're having like the top economic experts of the United States being like, inflation's transitory. It's because of backlogs of supply chain and this and that, and it's all going to go away and everything's going to be just fine. Well, like they just never dig into real information, So while they're saying this and they're raising rates, the Fed is still buying 10-year Treasury notes. They're still buying mortgage-backed securities, and they're doing all these things. So that's like, you equate it to like, if you're going to go on a diet on Monday, you smash every cheeseburger in town for the 30 days prior to that, right? So that's kind of what they did. And so now they've done this like massive increasing in rates. And it's finally at this meeting, what the highlight was, like the positive news, is that Jerome Powell came out and basically said, like, finally we're seeing goods prices go down. So, and a lot of that comes from improving the supply chain and getting that. Remember those days? Like, remember we were doing this in the other room? And we had that picture. Wasn't it like San Francisco's Bay or something? There's like freighters everywhere. And they couldn't offload these ships and everything. Yeah. So we figured that out finally, right? Like we should have, like, again, so supply chain figured out. So they, when he came out and he was like, this is like we're finding that goods prices are finally coming down and it's disinflationary, which I thought like, I just thought deflation would be the word, but I guess deflation means something totally different economically that's bad. So they say disinflation, which doesn't, it sounds like when I'm talking to my wife about something I don't know about.
Yeah. Yeah.
So it was, it was actually, it came out to be a pretty positive press conference, as much as he tried to not be positive.
Yeah. Because the supply chain, let's just stay on that for a second, then we'll kind of work through each point one at a time. So when it comes to supply chain, just things are getting better, right? And you're starting to see what's funny about that is car dealerships have a lot more inventory in the lots than they ever have before.
Yep.
And so that is obviously helping prices come down, is essentially what he was talking about.
Right. And you're starting to see a lot of a big part of that, which ties back into what we do, is commodity prices, right?
Sure.
So a lot of, if you think about it, a lot of like pine, right? So like where wood comes from and aluminum, a lot of that comes through Canada.
Right.
If you remember, Canada was pretty strict on what they would allow and what they wouldn't, and things coming into the United States and not. Which, by the way, I read today that British Columbia has now, which is in Canada, I think it's is it a province or Providence? I don't know.
Providence.
Is it rhetoric or rhetoric? Like, we'll just never
Here we
know.
Go. I love it.
But they just legalized cocaine, methamphetamine, and something else.
In Canada.
In British Columbia, Canada. Yeah, it is like total free-for-all in that province now. So province. So that's like the new, remember back in the day, like Amsterdam had that red light district, and you're like, oh, that's crazy.
Right.
Like that's what British Columbia is now.
No shit.
Do anything you want. It's lawless. Anyway.
Wow.
Yeah. Going back to it though, so when you look at like prices for buildings, so you're starting to see like if you look at stock prices for like Lennar Homes or Pulte and Toll Brothers and some of these large national builders, you're starting to see housing starts increase, and you're starting to see a faster pace to getting to occupancy permits and things like that, and finishing some of these homes, which hopefully will help with supply, right?
Yeah, that'd be massive because you're right. I mean, all the lumber, I mean, that was a huge issue for builders.
Yeah.
And so as those things start to ease up, I think new construction, it helps everything,
Right.
and hopefully it helps, prices from the standpoint of making new construction more affordable.
Right, that and speed, right?
Because that's exactly right.
So being in the mortgage business and also building a house and having built a house before this is that
that's all you do is build houses.
I know it's the worst. Don't ever build a house unless you really
message to the audience. Don't build a house.
But if they attach the word custom to it, that means longer, expensiver, and annoyinger.
Yeah.
But the thing is with being able to complete homes, because Pulte could finish a house in like 4 to 5 months. Like when those guys are rocking and rolling and the supply chain is good and the labor force is good, those guys, because that's the biggest problem is, and it's just like the sentiment of how we operate is like now. And builders aren't building spec homes. Like you used to be able to get a Pulte neighborhood and they would just come in and build on every lot. They're just not doing, like they got their, like builders actually learned a pretty good lesson. They got caught with their pants down once and like, dude, I'm out.
You got a lot of people's pants coming down in this episode.
Did I say it twice?
That's right. So who you got the Fed's pants coming down, you got builders' pants coming down.
Everybody's pants are off.
All right, cool.
They learned their lesson though, and so that's the thing though, is if we can get those people, because we're going back to supply, right? Housing supply, housing prices, how do we ease this? Because there's still not a lot of inventory.
Exactly right.
And so the Fed, so they're in here, we're like, all right, we're gonna raise rates. And we're going to try to slow down demand for things. And that's going to increase mortgage rates, which should cool the housing market, which we needed because those appreciation rates were insane. But the only way, and you and I both know, the only way that you can really cool a housing market is to pour more houses into it.
That's right.
You know, and there's just, builders are now saying like, okay, we're not building a home until you've got the deposit on your lot, the deposit on your selections, and then we'll start building your home. We'll put the pedal to the metal. Well, it's a lot more realistic for most people to say, okay, if you can build my house in 4 months, that's cool. I can plan on that, sell my house, like the market's a little bit more stable, and we can get into the new one. We don't have to worry about that. So hopefully some of these things contribute to a more positive 2023 from a buyer perspective and I think from a seller's perspective.
Yeah, and we'll get into it more. So Powell gets into, all right, supply chains is easing, right? Things are getting better. It's helping different aspects. We raised rates 1/4 point, which we all anticipated. What else? Was there anything else worth mentioning in the meeting before we get into the housing and rates and all that?
Yeah, so he did. So the difference between like hawkish and dovish, right? Mm-hmm. So dovish is positive, hawkish is negative. And so his goal is to come out and have a hawkish perspective because they don't want the markets to go crazy. Right. So if you listen to the press conference, his statement was very hawkish. So he prepares a statement and said, you know, first of all, inflation is very stubborn and we're seeing the prices of goods go down, but the labor market is still very strong. We saw that today with our jobs report that absolutely knocked the cover off the ball. And so he's saying there's two big chunks that are not easing. That's the labor market, and that's services, right? And services are our economy. Like we used to remember like getting America on the road and we're this big manufacturing country. Yep. We are not that anymore. We're like Airbnb, Turo, Uber, Lyft, right. Like all these, it's service based, mm-hmm. right? And that's really where there's not enough people to fill those jobs right now.
Yeah.
And so he came out and he said, this is very, very stubborn. Like we are not going to stop raising rates and we are going to not stop tightening monetary policy until we see these labor markets easing. And then on top of that, we have shelter cost, which we've talked about before. And so shelter cost and labor make up just under 60% of inflation measurement.
Okay.
Right. So like if you look at CPI, that makes up like 60% of it. Well, of that 60%, that shelter cost is a lagging indicator. So we're getting data that we know that's going to hit in like April, May, June, that once we get that calculation actually on paper is going to be is really going to decrease that CPI number because we're using an average. So we've got a very high.
Absolutely.
So our high side is like 18% increases in rent and the current is like 3.6% increase in rent. And so we're continuing to compare it to 18% until we get to like April and then it goes down to like 6 or 7.
Right.
So that average is going to go from like 11% down to like 3.5, which will be that's going to be like our next massive move, which we've talked about. And
when is that? Just I want to make sure we don't miss that. April?
That should be reflected in the May CPI.
Got it. Okay.
So that'll be a big one. That'll be an interesting day. I think that's going to kind of set the tone for the summer.
Yeah.
And that's when we'll have some of these podcasts. So we'll start talking about some refinancing and identifying why and when.
Yeah.
And how.
And what it's going to do for buying season coming up.
Yeah, huge.
It's gonna be massive. So before we get into that, so let's talk about unemployment, right? So the Fed met earlier this week, first meeting of 2023.
Yep.
Then the unemployment report comes out this morning as we're shooting this, and you got half of the economists saying, listen, when we get into this recession, there's going to be a massive foreclosure wave because people are losing their jobs, this, that, and the other thing, which is happening. And at the same time, the happening meaning people are losing their jobs. You've heard of all the layoffs, Google. But at the same time, unemployment comes out this morning. And to your point, it's really high.
Right. We create so.
Isn't that interesting though? Like
it is. It's messaging, right?
Yeah, yeah.
I mean, there are so like the thing is like tech layoffs are very cyclical anyway, right? It's like
I want to talk about that too.
That's very common to see massive tech layoffs like that as those, especially with like the AI and some of that stuff that's coming out there's going to be a lot of redundancy in those roles that they use to like ramp up some of those big tech companies.
Yeah, and real quick before we get into that, what you just said is so good. The cyclical part about these tech layoffs or company layoffs, I was talking to somebody about this the other day, and they're like, well, what about all this layoffs? And don't you think it's going to be this, that, and the other thing and cause, havoc in the economy? Well, the thing is, when we come out of a market like the last 2 or 3 years, and these companies are all hitting records, right, with revenue, they have to have people to handle the demand. Right. And so all they're doing is a retraction back to normal. The same thing the housing market is doing. So if you look at these mortgage companies that are laying off thousands of people and people are freaking out, it's like, well, you don't need 5,000 loan officers when production's way down like you did when the market was going crazy.
Right.
It's just a retraction.
Exactly. And you got to think about it too, is like, so as a business owner, how many messages do you get a week for employee retention credit on your taxes, right? So on a tax return for a company, there's a line item that says non-recurring income. And that line item, depending on the number of employees, so if you're a massive tech company, you've got a massive line item for non-recurring income. Well, that non-recurring part of it is going to stop. The recurrence of that is stopping, right? So we're getting away from all this COVID emergency, pandemic emergency type of thing.
Yeah.
And so a lot of these companies too don't have that's a big chunk of revenue that was kind of like, you don't want to say free money, but essentially it's like free money, right?
Absolutely.
So now it's kind of like, okay, let's check the books. So there's redundancy, stopping some of this, this recurring income and things like that. But at the same time, when here we are in this recession and this coming recession is we're looking, the experts are looking for 185,000 jobs created in the month of January. And we got the report today, and it was 517,000
Unbelievable.
Unemployment is at a 50-year low. So it's something we've never seen before. And there's other data you can look at. And one of them that I always look at is like the job openings per employed person. So there's 1.9 job openings for every person that is unemployed right now, which is pretty wild. I mean, you think about it, like, you're like, man, that's crazy. There's so many jobs. Like for me, I'm like, well, here goes anybody that's pissed off at work. Like you don't have an excuse anymore, right? Like if you don't like your job and you work at a car dealership and you refuse to return people's emails that are begging you to sell them a brand new car.
Oh, that's
like,
funny.
You can go do whatever you want now and that job will get maybe filled. I don't know, but you've got all these other opportunities, right? Which is just a crazy time. And if you think about it, and so you look at what the Fed is saying, is that their job is to manage price stability, right? And they want to control inflation because what we've seen is not healthy, right? Like especially for people in like the middle income and lower income range, it just doesn't work.
Yeah.
So their job is to manage price stability and demand and employment at the same time. And so what they've been talking about, if you pay attention to it, is a soft landing. So like, how can we destroy demand over here, lose a few jobs at the same and look good, right? Like we don't all want to get told we're complete assholes tomorrow,
right?
And that we ruin the economy. So now they're looking for this soft landing. Well, this labor market makes that soft landing pretty easy to come by. So it'll be interesting to see how they can maneuver that, some of their decision making, their monetary policy, and keep keep people working and get the pricing under control. So
it's interesting. So let's talk about the effect that had on mortgage rates.
Yeah.
Because, there's all kinds of things that are affecting mortgage rates, but one of the big things is this job report.
Yeah.
So, when the markets look at the job report and they're trying to say, okay, where's this coming in at? As unemployment goes up, mortgage rates go down, and the exact opposite. So now that we get this job report that comes out this morning, that's like, holy shit, I can't believe how many, new jobs are being created. The bond market doesn't like that very much.
No, it hates it.
So let's talk about that.
So right now you don't look at rate sheets, right?
That's right.
So it's going to be, and this happens every time, whether it's good news or bad news. There's always, like when we were talking the other day and the Fed met, I said, hey, look what I did for rates. Like rates were 5 3/4, 5 7/8. They were really like, we got that big bump that we needed. And you're like, well, what are rates today? I'm like, let's see what they are tomorrow.
Yeah.
That's exactly what I said. And yesterday they held on. So they had like a little bit of an up and down day. It was just very, very minor change for the worse, very minor change for the better.
Right.
And they did that all day. And then today we got the jobs report. It came out and rates are probably 0.5% higher right now. I would guess after all the data gets analyzed, because that jobs number, there's that it tells me like the markets are worse this morning. Like you don't, it's a bloodbath a little bit, but it's starting to get better and it's not as bad as it could be. Mm-hmm. Like if it were the other way around, rates would be plummeting if it was, 5 times worse than what they expected. So if it came back at like 40,000 jobs, like it'd be a great day for rates. And then what happened is they'd figure it out, they'd analyze the data, and the market would correct itself. And we'll probably end up today where we closed yesterday. So really, I still think it's going to keep us. We're in a very strong, like 5.875 to like 6.375 channel in rates right now. And it needs that. And we're breaking through, right? Like we get out of this little channel and then we get back down. We get out of this channel, we get back down. So it's going to take another big news item to get us out of that. And that's what we're kind of leaning toward. That May number is the one that could like break us to a new channel for rates.
Yeah. And as it relates to the housing market, the thing is, it's like that chicken or the egg thing I was talking about.
Yeah.
As the economy gets further into a recession, that drives mortgage interest rates lower, which then impacts the housing market in a great way. And that's the thing people, I think, have a tough time correlating. It's like, if the economy is doing worse, it's like this teeter-totter effect, right? As you know, it's like the housing market's doing better. And that's the thing I think people in the industry I don't know why, they don't understand that. They don't understand that as the economy gets worse, as we get into a recession, mortgage rates go down, drives buyer demand in the housing market, and that gets us back on track. I think that's probably what it looks like here in spring. And I think that we're going to have a really good, strong, market or a good year in 2023.
Right.
What are your thoughts? What's your opinion?
I agree with that. And for people that don't see that correlation, right, or understand it, or maybe you have a technical brain, to better understand it is, so you have a mortgage-backed security, or you have like a 10-year, like a mortgage-backed security is what it is. It's a long-term bond. It's a very safe, lower yield investment tool. So when we go into a recession, what happens to the stock market typically? It gets worse,
Absolutely.
Right? So these big investment firms, I'm always talking about these guys. I don't even know the name of one. Like, I don't know. So anyway, moving on. So these big investment firms, though, will buy up
UBS.
a large chunk of mortgage-backed securities when there's a recession. So there's a big demand for mortgage-backed securities because, hey, we still want our clients to get something, but we don't want them to lose all their money. So we're starting to see this recession coming. We're moving them into a cash position because inflation is high.
Absolutely.
Then as we start dipping into the recession, it's either like, you're watching the market to maybe buy a dip or make a certain investment. But in the meantime, we can park our money in this low yield, safe mortgage-backed security where maybe we're getting 3-4%, 5%. There's a larger demand for that. Well, in the mortgage world, we're like, oh, look, there's more people that want to buy our mortgages. We don't have to charge as much for them. And so because there's a bigger buyer pool for them, you can provide a lower rate of return and still have that demand. And so that's why you see mortgage rates go down during a recession, as just like technically speaking, right?
Yeah. Yeah. So that's what I believe that's going to happen. And I think that the real estate agents and the mortgage loan officers, the people that watch this show, I think that 2023 will be a really good year. And I do believe it's still going to be a professionals market. I think that the number of loan officers and the number of licensed real estate agents will decrease, right? Because home sales will decrease. And so the opportunity will be different, right? Yeah. But I think for the professional who is doing this as a long-term career, chances are they probably pick up market share.
Yeah.
They probably have a better year this year, potentially, than they have last year.
Yeah, for sure.
So it'll be interesting. Now, you said one other thing. You said, man, things are starting to get busy. As we're making this podcast today, we're getting into February, right? March, April, May, they look good. What's the Mortgage Banker Association? What's their tone right now with applications, and what is that all looking like from on the purchase side?
Yeah, they're up.
Yeah.
I mean, I think they were up last week. They're up 27% or something. Yeah. So, I talked about this with you the other day. So even without refinance business, this is the best January I've had in probably 4 or 5 years.
That's great.
And it's all purchase business. There's zero. I mean, that's without any refinance business because normally the purchase side of things are sleeping till like March. And a lot of that has to do with, schools and kids and families and moving and like trying to strategize around that. Nobody wants to take pictures of their house with a Christmas tree in it or doing things like that, So it's usually this is like a pretty dead time of year. And I always plan on that, and now I'm like, holy cow, we're busy.
Yeah.
This is kind of interesting. And it's all buyer, purchase transactions. And a lot of these we're seeing with the seller concessions and things like that. And you're like, great, this is becoming a buyer's market. And then all of a sudden I have a buyer submit an offer and they're like, yeah, we got beat by an offer that was $14,000 over with an appraisal guarantee. And there were 14 offers.
Yeah.
It's like,
there's still multiple offers.
Yeah. It's that in our market, in my market where I'm at, Metro Detroit area is that like 400,000 to 600,000 market is the starter home,
Yeah,
and it is just banging. And it's funny because the people that are in there now, I'm helping them with their purchase and they're like older folks, like 65, 70 years old, retired, and they're moving into a condominium, like a site condo, right? 1,700 square foot, $500,000 beautiful single family site condo.
Yeah.
One floor,
And that right there, not to get off on a tangent, that's what I'm coaching every agent that I'm working with right now to do, is to go after downsizers. It's like the best business because you're working with people who have accumulated wealth over their career.
Yeah.
So their houses are paid off in most cases, free and clear.
Yep.
They've got a lot of money to put down on a next home. It's like the best clientele for a real estate agent or a loan officer. And I don't understand why more people aren't going after that niche, but that's a whole nother episode.
My question would be, where do you put them?
Yeah.
Like this one, the one I'm doing, right, is it's going to be a 200 home complex, with like a straw between each one. Like they're very narrow. It's a condo, right? The association mows the lawn, does everything, but they're single family properties. But they're all like all the lots already have sold signs in them.
Yeah.
Like they're going to start blowing these things. That's just crazy.
Well, a lot of those people too, assisted living niche starts to come. I mean, those are popping up everywhere too, right?
Yep. All over.
So, when you look ahead, what are you looking forward to as it relates to things that will be a driver of mortgage interest rates? Are there future? You talked about a couple future reports. Maybe some future Fed meetings. What are the things that we can look forward to that will impact rates the most?
So continuing to watch inflation. So there's the CPI, the Consumer Price Index, and then there's PCE, personal consumption expenditures. So those are the two big inflation reports, and they're really going to be watching for what's called shelter cost. And none of this stuff is like mainstream, right? Like when you start digging into the data, it's just the inflation number. And so what was the highest inflation got? It was like 9.1%.
Yeah.
Like the headline inflation.
Yeah. And where are we at right now?
6.5.
Yeah.
So, I mean, we're really moving away from that, and it's funny when when people were calling rates like 10%, 11%, foreclosures are going to be up 500%. Well, here we are. We're at the lowest we've had rates since September of 2022. We're about 1.25 1.5 off of our highs. So we've had a substantial move,
right?
Like we've already made leaps and bounds, and we're going to get into, I really think that, without the bond buying and without the government providing liquidity to the market, I think that mortgages are generally going to trade between 5 and 6%. I think that's ultimately where we end up, and that's where things are going to normalize, and that's where people can plan.
Yeah.
So going forward in my business, we're looking at all the people that have bought homes in the last 6 months. Like, hey, this is the time we can look at refinancing for you and get you out of some of those rates and make that move down.
Right.
And track those loans. And then also this year is, I think that, and I don't have any proof for it, but it's like that psyche thing where people are like, there's not that much negative news. Remember, there was a while there where it was just all like doom and gloom.
Oh yeah.
Like housing, mortgages
meltdown,
are going on,
the whole thing,
everything it's done, it's all done. And now it's crickets.
Yeah. Well, that's what I was going to say is I think that the worst is behind us.
I do 100%.
We made future or episodes in the past when we talked about, hey, listen, the fourth quarter of 2022 was just a nightmare.
Yeah, it was bad. Yeah.
It was very, very bad. And that's in our rearview mirrors. And I think that moving forward, my prediction is that things just continue to trend slowly to get better.
Yeah, I agree.
That rates, like to your point, I've been saying this the whole time, probably land somewhere around 5.5%.
Yep.
And we hang out there for a while.
Yeah,
and
exactly.
that's the market that we're in. It's a nice, neutral market, which I think will help people get off the sidelines that want to buy a house. And then the sellers that are trying to say, well, hey, what are rates going to do? Because I just got to see where this market's going to land.
Right.
Once we land where we're going to land, 5.5, 5.75%, they said, okay, this is what it is. Let's make the move.
Right.
So it'll be interesting to see what happens.
I agree.